All right, so I'm Michael Hartzman, and I'm back with Dominic Tavella. And tonight we're thrilled to bring in John Eade, who's the Director of Portfolio Strategies at Argus Research. And Argus is a new friend of our firm, Dominic, but one that's actually been around for 86 years. So throughout my career, I've always heard the name Argus. Really happy to know over the last couple of months, we've gotten to know them better. So John, we're thrilled to bring you in. And before Dom and I jump in with our million questions, why don't you just spend a few seconds and give us some background on Argus Research?
Glad to, Michael and Dominic, and thank you for having me on today. Dominic, I love that sunbeam coming in on your shoulder. I've got a shadow from the 6-foot snowbank outside my window, but good for you. So Argus, Michael, as you said, is an 80-plus-year-old independent financial services firm. We're based in New York City. Of course, we haven't been in our offices for about a year now. We'll get back in at some point. And then we've got offices in London and in Stamford, Connecticut as well. We have 3 businesses: a money management business. We are a registered investment advisor with the US SEC. We also have a financial data business that's primarily run out of our London office. And then in New York is our core independent investment research business with a team of about 20 analysts and strategists covering almost 500 leading US and global companies with buy, hold, and sell ratings. So that's in a nutshell what Argus is.
All right. Thank you. Thank you for that background. And, I read over the deck that you sent yesterday. And, could we just start with kind of your 8 fundamental forecasts and the dumb for 2021? And I guess the dumb question is, I made the comment in our first segment that in the long term for 2021, yesterday was just a Monday, right? I mean, I don't see this great sea shift in the market because you have a day or two where the technology sector gets weak and there's some sector rotation. Do you have anything to add to that? Did you see anything fundamentally change in the last few days, which would get you to change your opinion or your outlook?
Well, Michael, you touched on one of the drivers of the recent volatility, and that's been the uptrend in interest rates. But instead of going over, 8 forecasts, why don't we just go over 1 or 2? And I want to make the point that Argus is bullish on US stocks for 2021. So we are expecting the S&P 500 to end the year up maybe 10, 12%. And that's based on our outlook for a recovery and stabilization in US GDP. We note that while interest rates have risen slightly at the long end, they're still nothing like they were 10, 20 years ago. And 1.35% on a 10-year is not a great return for a long period of time. So low rates are favorable. We just got through the 4th quarter earnings season. We're getting through that now. Results have come in better than expected, and they're going to be even better in the 1st, 2nd, and 3rd quarters of 2021. So you've got those 3 very positive factors. And then kind of putting a damper on a great year for stocks are valuations. And we've seen stock prices rise sharply post-pandemic, even as earnings haven't recovered. So you can't say the market is undervalued here, but we do look for a positive year based on good economic growth, generally low interest rates, and strong earnings, especially in upcoming quarters.
So, John, in just the last week or two, we've seen these high-flying growth stocks, right, the FANGs in particular, that just could do no wrong. And I think for the most part gave us pretty exceptionally good numbers, good, strong numbers, top line, bottom line growth numbers. And now they've sold off 10, 15%, in some cases even more. It's hard for me to believe that money managers are going to completely get out of that trade and look to buy the stay-at-home stocks. What are your longer-term views on that?
Well, longer term, Dominic, I think our U.S. economy, and we've thought a lot about this over the past few years, does maybe 4 or 5 things really well. And that's what you should be investing around. One is we come up with great technology solutions. And we see that with all the capital that is flowing in the tech sector today. Two, we're pretty good at research and developing breakthrough drugs. And here we have a lot of vaccines and treatments for COVID-19 coming on. Three, we make some pretty good weapons. Like it or not, the defense industry is something that we do very well. And if you're looking for values in the market right now, you can find a lot of them in the defense sector. The fourth area is the supply chain and consumer-facing businesses. So the consumer sector, we think, is something to latch onto. And the fifth area is what we're doing here. Our country is very good at raising and allocating capital. So a lot of the banks and financial services firms, which are some of those value firms that are doing very well right now, are also well positioned for the long term.
John, when the pandemic started last year, obviously everyone's forecasts had to really, shift on the fly. What did August do around February, March, about a year ago, as it dawned upon all of us that we were going into this prolonged shutdown and this prolonged season of really, the economy being on hold?
Well, Michael, we tried to keep our wits about us, right? We're an 80-year-old financial services firm. I've been at the company over 30 years. My director of research has been there 29 years. We've been through some cycles before. We know cycles come to an end, like the 11-year bull market that we had been in through February 2020. And we know that new cycles start, but then can come to an end as well. And they typically follow the fundamentals, right? The fundamentals of the economy, of interest rates, of earnings, and of prices. So one of the things we were really glad to see in February and the March was the Federal Reserve to step up aggressively and lower rates to zero and start to backstop financial markets and buy longer term financial securities. Then there was also another, more pleasant surprise that Congress actually got its act together and in a bipartisan measure passed the first, COVID Relief Act and injected almost $2 trillion into the U.S. economy. The U.S. economy is about a $21 trillion economy. So they put 10% into the economy right there. You started to get a feeling that the economy would recover because of the two-pronged action from the government. At the same time, volatility was skyrocketing. And so we were guiding our clients to some of the financially stronger, maybe more mature large cap companies. Our consumer staples analyst upgraded Procter and Gamble and Coca-Cola at the bottom of the recession. Our tech analyst put Intel back on the buy list because we saw these great values in these great franchises. And so we tried to keep our eyes on the fundamentals, the companies with the strong balance sheets and the talented management teams, balance sheets carrying companies through the pandemic, and management teams taking the companies to the other side were some of the things we were thinking about as the pandemic started to unfold.
Hey, John. So one of the things that gives me a little comfort to agree with some of your year-end numbers on where the S&P might end is the consumer. And the consumer's been bottled up now, right, for well over a year, and they have, unfortunately, some have been laid off, but for the most part, they have a considerable amount of cash sitting on the sidelines. And when they get that opportunity to spend, they're gonna spend, right? So I'm positive about that and its effects on the economy, but I also worry that there's going to be an awful lot of money chasing a very few amount of goods. I don't think the capacity is going to be up and running on day one. So any inflationary concerns and what that might do to the markets?
I think we're seeing that those inflation expectations start to drive those longer term interest rates a little bit higher. There's not much the Fed can do. They can do a lot at the short end, not as much at the long end. And the Fed has gone on record to say that they'll live with inflation, a little bit above 2%, if that will bring that unemployment rate, which is now around 6.3%, down closer to 4 to 3.5%. I do think that there probably will be some goods inflation, Dominic, like you're talking about, whether that's from higher input costs or higher energy costs. At the same time, another major factor for inflation is wage pressures, and the trends that we've been through recently, with globalization and better trade opportunities have really helped keep wage pressures under control. So I don't see, I certainly don't see us going back to the pre-Volcker years. Almost all the inflation measures we look at right now, and I've got some of them in a chart I sent over to you, 10 of the 12 are below 2%. So maybe by this summer, if more of them are around 2%, that could be a concern. But to your point earlier, at that point, I would expect the unemployment rate to be closer to maybe 5.5% or 5%, the economy to doing very well, and corporate profits to be recovering strongly as well. So they all kind of fit in there together.
John, we agree with you about interest rates staying low at least until 2022. I mean, the Fed has, really indicated that. And I do think Janet Yellen was a good pick for Treasury Secretary, being a former Fed chief. Sure worked closely with Jay Powell pretty well. But looking forward past that, you mentioned the $2.2 trillion that was injected into the economy, and there's more to come. When do we start ever to think about this deficit?
Oh, Michael, I think it's around 125% of GDP now. And in the 80s, it was like 60% of GDP. And, we've got another couple trillion coming down the pike. So we're probably going to be, maybe 140, 150% of GDP. Right now, to your point, it doesn't matter. Interest rates are still very low. Nobody's anticipating the U.S. is going to default on its securities. Most of the debt is owned by people in the U.S. who, just assume that the Treasury will keep the printing presses going. I think total debt owned by foreigners is 20%, and it's not in China's interest to sell or Japan's interest to sell. So we've got low interest rates. The dollar has come down a little bit. It had been at all-time highs in last first quarter of 2020 when there was the flight to quality move into U.S. Treasuries and the dollar. It's come down a bit, but it's still relatively high. So you have that confidence around the world that the U.S. is going to be able to lead global growth on this other side of the pandemic. I think what you would need to see, Michael, is either Europe or China, really become a dominant threat to the U.S. And right now, the Chinese economy is, I don't know, maybe 25% less than the U.S. economy, but on a per capita basis, it's like 20% of it. So there's a lot of lifting of consumer lifestyles that China is trying to do. That's going to take a generation at least. So I think we've got some runway, Michael, to do the spending here and then fix up the balance sheet before the globe actually comes and asks us to pay.
So, John, I kind of wanted to save this question for last, but I want to give you enough time to maybe give us an intelligent answer. So, what screws this up? I think we're on a good glide path towards year end. Vaccinations, economy opening, spending. What screws this up?
Well, we've talked about a couple of factors. We've talked about maybe inflation does spiral out of control, and interest rates do perhaps get up to 2.5% or 3% on a 10-year. that's going to, I think, take a lot of people out of the stock market, right? Because they can get some income now out of bonds. So that's going to, probably drive a hole into this, bull market that we've seen recovering. I'm not really worried about oil prices spiking higher. I think you've got a global secular trend of approaching, peak oil demand that just going to reduce the need for oil, and you're not going to see the kind of supply or demand issues that we've seen in the past. So I'm not worried about oil. We got through the presidential transition, right? That was good news. Maybe, Dominic, maybe the recovery in Europe and overseas doesn't go as well as people like the IMF are anticipating, right? Europe is about to go into a double dip recession here in this first quarter. We're not going to have that in the US. And the vaccine supplies may be slower to get out to some of the emerging markets, and COVID may linger there longer. So I think there could be global growth disappointments as something to be concerned about. But here in the US, I think we're going to have the low rates, the US economic recovery, and the good earnings growth for at least the next few quarters.
John, my last question. Last week we had a guest from JP Morgan, and he was the same situation. He was sitting comfortably in his house, and he was in either Connecticut or New Jersey, and he talked about eventually heading back into the city. So my question for you is, you've been doing this for a year. You look like you're pretty comfortable sitting in your den or your study. Are you anxious to head back into the city? Do you think August is going to bring their people back? Have you guys talked about that? Or do you think this is a new paradigm that a lot of corporate America is going to be sticking with?
We're definitely going to be coming back into the office. Probably not the way we were in the office pre-pandemic, but we've been based in New York since our inception. It's a great place to be, to see our clients in town, to see our clients when they come to visit. Maybe they don't visit in 2021, but they'll come in 2022, 2023. It's a relationship business. It's important to see people's faces, to give them a fist bump, I guess, if that's what we do. Also, we're a company of ideas. We don't make anything really tangible. So the more that we have people coming together and thinking and talking, I think it's easier for our sales team to, really get a sense of what we're bringing to our clients. And I think that strengthens our sales culture as well. Plus, Michael and Dominic, we've been very productive, in our year outside of Argus, but we've got a very experienced staff, and we're going to have to prepare for the day that, people like me or the owners of the firm retire, and we're going to need to bring in a new generation, and we're going to need a place to recruit them and train them as well. So for several reasons, we will be back in Manhattan, but I don't see that until end of summer at the earliest.
So
And John,
ultimately,
we're running out of time. So one last question for me. You've had capital available, it's liquid. Where's the place you just jump on right now to put it to work?
Well, we talked about defense stocks, right? They're very cheap. They've sold off with a Democrat in the White House. It's a very good industry. It generates a lot of cash. You can get 2 to 3% yields from defense. Also, the banks have kind of gotten out of the bag, right? That's probably not as attractive anymore. But Dominic, one of the themes that we like is dividend growth, and companies that grow their dividends at least 10% a year. They are rare, but when you find them, they have the strong balance sheets, they have the focus on shareholder returns, and they also have the confidence in their near-term outlook to increase the dividend at a double-digit pace. So those are some of the characteristics that we look for in companies that we like. And that could be like an Old Dominion Freight Lines. It could be a Lockheed Martin, a Nike. It doesn't really matter on the industry, but these have been successful companies delivering successful shareholder returns.
Great ideas. Thank you.
Thank you, John. We appreciate your insight. We appreciate you making the time this evening. And thank you for sharing your wisdom with our clients.
Thank you, Michael. Thank you, Dominic. Have a nice
Brady,
evening.
Be safe and look forward to doing this again someday.
Thank you.